All right, welcome back to another edition of Financial Accounting. Today is Friday, April 23rd. Happy 23rd. We're going to finish up talking about Chapter 10 today. We're kind of ahead schedule, so it'll probably be a quick class, but I'll leave it open if you guys have any questions or need any help on anything. Um, 10.3 and 10.4 homework are going to be due on Sunday. So make sure that you have that on your calendar. And then we're going to pace out the remaining homework assignments. So one homework, and then final homework 11.3 due not this upcoming Sunday, but the following Sunday, May 2nd. So then last day of classes, I believe, is May 4th. And but we're going to have a review. We'll probably be able to start a review on next Friday. Now, as far as the final exam is concerned, I'm still waiting back to hear from the course coordinator any updates or changes to the final exam. So I'll get those notes up to you, those review notes up to you, and as well as the practice exams need practice questions as well. I can give that up to you as well. And for the time being, make sure that you're getting this information down. Chapter 10 and 11 seem pretty straightforward, with the exception probably 11.3. That's a bit of a challenging part of the statement of cash flows, is just understanding where things go and how to construct the statement of cash flows. So we have plenty of time to get through the material. So just make sure that you're getting this information down as good as well as possible, and then reach out to me if you need help. Like, number one thing is, some of you guys are coming at me and right now and saying, I wish I'd reached out to you sooner, and that's totally understandable. Just realize, I'm going to be available all the way through your final exam. So, if you're going to have last minute questions, please don't hesitate to reach out to me. When we get to the end of the term, I'll give you guys some updates for office hours, just so that way you can know when I'll be available to reach out to. Or if you need to make an appointment, you can always just tell me the days and times that work best for you, and we'll jump on Zoom and meet up and go over anything you need to. So a lot more. Generally speaking, I've been available, 8 hours a week, but that's the office hours themselves are not the limiting feature. Just so if you want or need to meet with me outside of my office hours, just tell me the days and times, and it's very easy for me to jump on Zoom and go through and help and answer any questions you have. We're going to finish up chapter 10. Well, plenty of time today. Get in on the homework and get that stuff done. Your grades are updated through the homework from chapter 9. So I haven't updated chapter 10 scores yet. So just realize whatever score you see up as your total course points earned, that's all your exams 1 through 5, all your homework through chapter 9, and the extra credit project. That's up there. So any other points that need to be updated will be updated in real time. Your grade you see up here, as well as your percentage, is also in real time too. So if you have any concerns about what it is, how to calculate your course score, whatever, just realize that I'm taking your total points at the end of the term when we've gone through everything. The total denominator is going to be 500 points. So right now we have 386 is basically how many points we've earned. There'll be chapter 10, of course, will be updated, so there'll be an extra 4 points in there. But right now, whatever points you've earned, extra credit, exams, homework, those points are going to be in this third row, divided by 386, and that is what your percentage is. Percentages correspond to your course grade. You can look at the syllabus for that. Generally speaking, if you're in the 90s, you're an A. If you're in the 80s, you're a B, et cetera, et cetera. When we finish up, the denominator will be 500 points. So if you need a C in the class, you need 350 points. If you need a B, you need to get 400 points, et cetera, et cetera. So, but I can help you with that as needed if you're wondering like what you need to score on the final exam, et cetera. There is an exam replacement, so some people are kind of confused about that or what they need. I have my own sort of calculator I run through, so feel free to reach out to me if you just want to double check on any projections. Without any further ado, let's go back into chapter 10 to finish this bad boy up. We were talking about, when we started with 10.3, we're talking about treasury stock. Keep in mind that in general, what we're dealing with here is just stock in general. If we issue common stock to the public, realize that we're developing a relationship with people. These investors, they're not just passive people necessarily. These are people who are owners in the business. So there's certain things that we can do that, with regard to managing the common stock that can affect them either for the better or for the worse. Generally speaking, once we issue common stock, we are going to be hypersensitive about anything that the business does that could negatively impact our common shareholders because they are the owners. We want to keep them happy. Treasury stock is the common stock that we issued that we brought back. So is it necessarily different? Well, from an accounting perspective, it is common stock that has been issued, but it is that portion of common stock issued that we have bought back. So treasury stock is fundamentally our common stock that we issued. It's just the stock that we have pulled out of the market. So if we own the treasury stock, generally speaking, buying back our shares helps the remaining shareholders with their shares outstanding. Generally speaking, it does. We talked about how to account for treasury stock and the different ways we could possibly deal with it. We can resell it, we can retire it, we can give it to our employees as a form of compensation. That's generally a good thing when we give it to our employees, realize we're doing it at the market rate, always the market rate. We can also just issue brand new shares. I threw that sucker in there just so you knew that giving employees stock, just granting them stock without having them to buy into anything, that's also a form of compensation. That is somewhat different. There's a slight difference between just giving them stock and giving them what's called an ESPP, an employee stock purchase plan, where they can actually buy the stock at a reasonable strike price. It's usually lower than just buying it from the open market. That's not what this class talks about. We don't deal with ESOPs in this class. This chapter 10 is not just about what are the accounting rules with issuing stock. It's about the relationship with our stockholders, our owners. And by now, hopefully you realize that accounting is about numbers, but numbers represent people. And so I don't want anybody to think that, as an accountant, we're just sort of crunching numbers. As accountants, we're always working with people. It's just that we are transcribing information into a language that helps us with our financial reporting. Accounting is a language of business, but business is about people. So don't just think about these numbers as just, benign things. It's like, no, they represent relationships, and we want to maintain those things. How can we maintain a good relationship with our stockholders? Well, we can issue them dividends. So we started talking about dividends, such as in particular cash dividends. What do cash dividends do? What's the process by which we declare and pay out the dividends? We've seen this before from the beginning of this course when we're paying out dividends. There's just a few record dates or dates in particular that you just want to pay attention to, because from a practical perspective, there's usually a process. Board meets, makes a declaration. Then we figure out who actually owns the stock and who to write the check to, and then we finally just pay out the checks. So those are all just the cash dividends, but we can make our stockholders happy by also issuing a stock dividend. And it seemed weird that we just give them other additional pieces of paper. We're just printing off more paper and giving it to them. You think you just want to remember when we're issuing common stock that usually we're issuing it as a percentage of existing outstanding stock. So small stock dividends are the most common. Rarely do you see companies issuing anything in terms of a large stock dividend. Small stock dividends I've seen on average between 3 and 5%. And that's just saying that we're going to issue 5%. Whenever the outstanding stock is, we're going to issue 5% more. So we went through the example where we said if we had the 50,000 already outstanding and we wanted to issue 10% more, first calculation is just multiplying those two numbers and reminding ourselves, that means we're issuing 5,000 new shares. Once you figure out that we're issuing 5,000 new shares, then it just becomes a matter of multiplication. Start at the top by multiplying the 5,000 shares times the market, always using the market to determine the value that we're providing people. If it's not cash, we have to pay attention to the market value. Cash is always going to be cash, so the journal entry is going to be pretty straightforward. But In the case where we're actually issuing more stock, that's paper that we're printing. But how is it being viewed as a reward to shareholders? That's going to be based on whatever the market price is. They get these additional stock certificates. Why is this additional stock valuable? Well, because they can turn around and sell it. They turn around, they sell it, they get $9 per share. So for them, the value of each share is $9. Therefore, the dividend that we're giving out, not in the form of cash, but in the form of some piece of paper that has a market value of $9 per share. That's how we determine how much the retained earnings is. You start with that, and then you just kind of work your way down. 1, 2, 3. Always pay attention to par value. Sometimes that sucker gets snuck in there, and you just have to realize par value is just a tedious little aspect where we have to split up the credit between APIC and common stock par value. But keep in mind that the whole point of this, using the stock market, is to help us not pay cash. If we can preserve cash but still reward people, how can we do that? Use the market's cash out there. We're going to use the stock market's money or its valuation of these pieces of paper to give value to investors. That's what we're doing here, and it works splendidly. It still works today. There's also stock options, but that's beyond the scope of this class. Stock dividends, cash dividends. There's another tricky part about dividends when it comes to preferred shareholders. Preferred shareholders, they just simply get paid before the common shareholders. That's the number one reason why we consider them preferred shareholders. Beyond that, if there's nothing really preferential that we give them. Usually it's the common shareholders that have the right to vote who's on the board of directors. So preferred shareholders typically are just passive investors. They're just there to get a dividend. And usually the dividend we give them is stated as either a percent of the par value or some sort of dollar amount per share. So if we offer like a 5% dividend on the preferred shares, and each share has a par value of $1,000, then you do that multiplication, comes out to, what is that, $50 dividend per share. So that's one way for preferred shareholders to determine how much they expect to receive as a dividend. Sometimes they want that. They want that certainty, because if dividends kind of like are up and down, right? And people don't like, especially when they get old. Like my father is retired and he likes certainty. So he has definitely a portion of his portfolio allocated to bonds in the bond market and bond market funds. So he has a consistent stream of interest coming in. Sometimes people like preferred shares because they can predict how much they're going to get as a dividend. It's not going to be too low or too high, but they're going to get theirs first. That's the number one thing. Does it mean that they're better off than common shareholders? Not necessarily. So one thing that you tend to see, I think there's always some sort of question on the exam about cumulative feature. The cumulative preferred stock essentially means this. If a company decides to skip a dividend payment, what happens to preferred shareholders? They get nothing. It's this 5% dividend is not guaranteed. It is just a prediction of how much preferred shareholders expect to get if the board actually declares and pays a dividend. If they don't pay a dividend, preferred shareholders get nothing. And legally, they're entitled to nothing. So we can, if we're the company, we can skip a dividend payment, and preferred shareholders can bitch and complain all they want. But at the end of the day, they have no legal right to any dividends if the board declares none. This just simply says this is what you'll get if the board declares. Now, what if it's a cumulative preferred? Well, if we skip a dividend payment, then any amounts that we skip are put in arrears, meaning that we make a note that when we later on declare dividends, we have to pay preferred shareholders those amounts in the past that we have skipped. Those amounts get paid first. So you can have this preferred shareholders, and then you got the common shareholders. But if there's a skip payment, preferred shareholders get paid any in arrears, and then get paid their current portion. Then whatever's left over goes to the commoners. So it's kind of the order of priority: 1, call it 1A, 1B, if you will. And then scraps go to the commoners. And I say scraps because, peasants, scraps, they get whatever's left over on the table. So it sounds kind of bad, but that's kind of like how I like to look at these things and say, man, it must suck to be a commoner. Here's the example that I would recommend you kind of focus on. The company pays out, let's just say, $150,000 every year to these preferred shareholders based on their percentage or whatever this preferred stock certificate is. So 2015, preferred shareholders got paid $150,000. 2016, preferred shareholders got paid $150,000. 2017, the company said, let's halt on paying any dividends for 2017. Okay. Now, I think I told you this before. Practically speaking, companies don't stop paying dividends. But let's just say that they broke the cycle. They said 2017, we're going to hold off paying any dividends. Fine. Preferred shareholders don't get paid their dividend. That doesn't mean there's a liability from the company's perspective, because legally speaking, there's no requirement to pay any dividends at all. So this just kind of, if you're a preferred shareholder and you find out this news, you're like, okay, well, I'll remember that. 2018, the company decides to pay out dividends, and they make the claim that they're going to pay out a big lump sum amount of cash of $500,000 to all the preferred shareholders and common shareholders. Fine. How does this $500,000 get divvied up? Typically, preferred shareholders get paid first. So if preferred shareholders are going first, how do they get paid in that particular order? Well, first, they're going to get paid whatever was in arrears. So if there's any skipped payments in the past, those must get paid to the preferred shareholders first. Then preferred shareholders stick around and say, okay, I'm still here waiting on my current year's dividend. So they're going to be kind of pesky about this. They're going to say, okay, you caught up everything in the past. Now you have to pay me for the current year as well. So, we're like, oh crap, that's right. 300,000 total goes to preferred shareholders. What is left over? If you're a commoner, commoners get the scraps. They get the leftovers. So 200 is remaining. And that's going to go to common shareholders. So first figure out, when you're doing the dividends, first figure out the total amount, 500,000. Boom. Plug that into the dividends account, or if they just go right to retained earnings, that's fine too. Dividends are in total 500,000. Pile of cash. That's what we're going to pay out. Who do they go to? First priority goes to preferred shareholders. But realize this is two things: past in arrears and current portion for this year. Then, as a plug figure, the remaining portion goes to the commoners. Does it seem kind of brutal, kind of harsh to say, oh, the commoners get the scraps? It does, but I'm just saying it for the sake of helping you pass the final exam here. Just going to remember this order of how it goes. Commoners go last, they get the scraps. There is potentially a situation, though. You got to think about this and realize that, what if it wasn't $500,000? Okay, let's just assume for a second that actually it was, say, 1 million in total dividends. Okay, what would be different about this? Well, first of all, you'd be paying out 1 million, so that's a bigger debit. But preferred shareholders only get the maximum amount that's stated on their preferred shares. So they're still only going to get their 300,000, what was ever in arrears in the current portion, which means the commoners would be getting paid 700,000. So the scraps could be a lot, or they could be a little. It just sort of depends on how much in total dividends the company decides to pay out. So just be aware of the process here. A lot of this is just using some algebra, plugging in the x variable later. One last thing we can do to reward shareholders is declare a stock split. Now, just so we're clear, stock splits are not a dividend. Okay, stock dividends are a dividend. Stock splits are not. Stock splits are exactly what they sound like. We take the number of shares that are currently outstanding and we split them. or essentially another way of looking at it is double them or triple them. So the case where we have 50,000 shares outstanding and the company declares a 2-for-1 stock split, that means if you own one share, you're going to get that one share now equals 2 shares. So a 2-for-1 is doubling, a 3-for-1 is tripling, and so on and so forth. So now we have 50,000. We had 50,000 shares. Now we have 100,000 shares outstanding. Wow. How does that reward investors? Well, here's what it looks like before and after. Okay. So we got this, we have 50,000 shares. Price is, let's just say the stock price is $20 per share. Okay. And that is attached with a $50,000 quantity. Well, what happens when you double the amount of shares? So if I owned, let's say down below here, I own 7,000 shares and the current stock price is $20 per share, the value of that stock prior to the stock split is 140,000. Okay. Neat. What happens when it splits? It means now I have 14,000 shares. And what happens to the stock price? It gets divided in half. So it goes down to $10 per share. All we did is basically we shifted the supply curve way the hell out, basically to the point where now it's like the intersection is now at 100,000. Okay, and that's mechanically. That's what happens. That's how the stock market. How the SEC and the stock market work in conjunction to coordinate this split. So they look at the closing price at the end of the day, and then they impose the stock split. In which case they mechanically just, in this case, divide it by 2. We've got more shares outstanding, but it's half the price now in the market. So what is that? What kind of portfolio value is that now? It means I get $140,000. So it's the exact same value. I just have more shares, but each one is worth half as much. Twice as much in shares, each one worth half as much. That's how a 2-for-1 works. Why is this a reward to shareholders? Well, immediately you look at this and say, this is bullshit. This is like some sort of scheme, right? No, it's not. Microsoft did this for years before paying out dividends. And they were smart in doing that because, think about it like this. That's currently the stock price. What happens on day 2, day 3, and onward? You've got a very attractive company that now is much more affordable for new investors. So what you would see over time is a shifting of the demand curve. The price will go up because we make it a more attractive offer, more attractive purchase. So I can look at this and say, hey, over time, this $10 will creep up to 12 and 14, then maybe goes all the way back up to 20. Who knows what happens, right? But the point is, by making the stock price more affordable, we attract new investors. New investors means more demand. More demand means greater price on the stock market price. That's how they feel rewarded. Now you got like yourself the 140,000, you got yourself 14,000 shares, right? You multiply that by $20 per share. What is that? 280,000. So you can easily see how people who get in on the ground floor at Microsoft, how quickly they became very wealthy in a short period of time. But how did that happen? We used the stock market's money to make existing shareholders richer. But that's only if the stock is an actively traded stock it's a reputable company and there's no impediments to buying or selling the stock. There's a lot of assumptions that go on here. But theoretically, that's what happens. And as we saw with Microsoft, that's how Microsoft created a bunch of millionaires in a quick period of time. They just keep splitting the stock, do a 2-for-1, another 2-for-1. There's no accounts that are affected here. We quite literally just work with the SEC, file legal paperwork. There is no journal entry. So 2-for-1 stock split. Currently 50,000 shares, $1 per share par value. That's par value. It works the same way. After we do the split, now we got twice as much in shares outstanding, but now it's half the par value. Okay. So that way it looks, at the very least, what we had was 50. The total par value in that case was what? 50,000 par. And what is it now? 50,000 par. We're doing it for the sake of attracting investors on the stock market. From an accounting perspective, the balance sheet hasn't really changed at all. So that's a way we can reward our investors, is do a stock split. It doesn't cost us any, well, there's money for legal fees and something. Practically speaking, there's no journal entry. There's very little cost. It saves cash, makes investors happy because we are using the stock market's money to reward investors. Those are all the notes I have for chapter 10.